Hello all. Today we'll have a discussion on the topic revenue recognition methods. So there are basically 5 questions we are trying to answer in this video. These are the questions. Question number 1. What are the revenue recognition methods? Question number 2. How do you recognize revenue under sales or delivery method? Question number 3. How do you recognize revenue under production method? Question number 4. How do you recognize revenue under percentage of completion method? And the last question is about how do you recognize revenue under the installment method? So let's look at the very first question. What are the basic revenue recognition methods that are available for a seller to recognize his revenue for a particular period of time? So according to the commonly available practices, of course we know that IFRS 15 is talking about revenue recognition across all the industries under the contract method, wherein we discussed the seller can recognize revenue only when the control passes to the buyer from the seller, wherein control means the buyer has the ability to influence the usage of the product or service the way in which he wants. That is what the basic crux of IFRS 15. In India it is Ind AS 115. We discuss about that. So now we are coming to the basic revenue recognition methods that are available for a business entity in order to recognize its revenue in a particular period of time. So you can see guys, there are 4 methods that are basically available. The very first one is known as sales or delivery method. The second one is known as production method. The third one is known as percentage of completion method. And the last one is known as installment or collection method. So the second question is this: how do you recognize revenue under sales or delivery method? As I told you already, the default method in revenue recognition is sales or delivery method. That means revenue is recognized upon delivery of product, or if it is a service, upon substantial performance by the service provider, he or she can recognize revenue. For example, if you are talking about a FMCG company, the moment the FMCG company delivers the product to the retailer or the intermediary, the company can recognize revenue. If it is a service entity like a hospital, the moment it performs its obligations entered in the contract, performance obligations or promises as per the contract to substantial extent, then it can recognize revenue. In addition to this, in addition to delivery and your substantial performance, the next point here is the customer has to have acceptance. Okay, so the seller is providing the delivery or he is performing the service. In addition to that, the customer should give the acceptance. That means the customer has received satisfactory performance delivery. In that case, you can recognize revenue under delivery or sales method. The second method is production method. So it is not a common method. It is normally used for agricultural products or natural resources. In case of agricultural product, in most of the countries, the government goes about supporting the farmers by way of providing minimum support price. So the price is fixed. In case of countries where commodities are traded, you can try to get the closing price of the commodity on a particular date. So that becomes the base in which you can recognize revenue. So the most important condition is revenue is recognized under production method upon production. That means you have produced the product, you have harvested the product, and you have the availability of the fixed price. If the price is volatile, then you cannot recognize revenue. For example, companies dealing with mining, say for example coal mining companies, right, or lignite mining companies, right, or companies dealing with natural resources, once upon a time they have used production method for revenue recognition, wherein the price was more or less stable. Now the prices of commodities are going up, coming down, they are quite volatile. So mining companies are not using this method. Nevertheless, we can say that it's a theoretical method which can be used for agricultural products. So that means this method has limited usage. The third method we are going to talk about is one of the most widely methods. Most of you must have come from IT, information technology sector, And if you look at the annual report of most of the IT companies, you will find this, they are recognizing revenue under percentage of completion method. That means we are talking about contracts, we are talking about long-term contracts wherein the performance is happening over a longer period of horizon. So that means the contracts can be divided into two types based on the price agreement. One is known as fixed price contract. As the name suggests, the price is fixed in advance. Come what may, the buyer is going to pay the seller the agreed price. That's why it's known as fixed price contract. The other one is known as cost plus contract. That means the base price is fixed. Okay, that is fixed, minimum price. For example, I can say that the price is going to be 5 crores, right? Plus, okay, whatever cost I am going to incur, plus whatever is going to be the profit margin I am going to add upon. So this is a variable price contract wherein the price is fixed on a formula. It is basically known as cost plus reimbursement or cost plus margin formula. So if the contract is based on fixed price, then we can divide the contract into two more subtypes, namely completed contract method or percentage of completion method. I repeat, contracts can be classified on the basis of the price which is agreed between the buyer and the seller, I mean service provider and service receiver. If the price is fixed in advance, it's known as fixed price contract, which can be divided further into two subcategories, namely completed contract method or percentage of completion method. If the price is based on a formula wherein the seller or the service provider has no clue about what will happen in the future, so what he is going to do is he is going to arrive at the price using a formula. The formula is going to be cost plus reimbursement, I mean cost plus margin formula. If the price is fixed, then it can be divided further into two more divisions, categories, namely fixed price contract, I mean based on completed contract method, or fixed price based on percentage of completion method. Please mind, in both the subcategories the price is fixed in advance. Okay, so let me give you some example guys so that you understand what I talk about. So let's take a hypothetical firm, namely Tridib Kshitij Lakshay Limited, TKLL it is. They have entered into a 3-year contract with a customer, and all the amounts are given in INR, Indian National Rupee. So the life of the contract is 3 years, year 1, year 2, year 3. The cost incurred in year 1 is 10 lakhs, the cost incurred in year 2 is 20 lakhs, the cost incurred in year 3 is also 20 lakhs. Customer has paid 15 lakhs in year 1, 25 lakhs in year 2, 30 lakhs in year 3. When I say year here, I refer to the end of the period. So the fixed price is INR 70 lakhs. Okay. So now there are two questions. Question number 1 is, what would be the revenue, expenses and income under a completed contract method? Question number 2 is, what would be the revenue, expenses and income under the percentage of completion method? Okay. So now let's look at completed contract method. If it is completed contract method, as the name suggests, the revenue, expenses and profit are recognized only upon the completion of the contract. Let me give you the breakup of that. Suppose if this company, that is Tridib Kshitij Lakshay Limited, is going to follow completed contract method, what they are going to do is they are going to prepare a table like this. So the contract is getting completed only at the end of the year 3. So that means year number 1 revenue is 0, year number 2 revenue is 0. Year number 1 and 2 expenses are 0. Thereby year number 1 and 2 the pre-tax profit is 0. But at the end of year 3 the company is going to recognize revenue of 70 lakhs because it has performed the service. It has performed substantially. When it is recognizing revenue under the matching concept, you have to recognize the expenses also. So the company is going to recognize total expenses of 50 lakhs only upon completion of the contract, that is at the end of year 3. Thereby the pre-tax profit the company is recognizing at the end of year 3 is going to be 20 lakhs. Kindly look at the table once again. The contract is getting over only at the end of year 3. Since we are following completed contract method, in year 1 and year 2 no revenue, no expense, no pre-tax profit is recognized. On the other hand, at the end of year 3, revenue, expenses and profit all are recognized. Okay. So what you have to note is only this point, right? That means only upon completion we are going to recognize revenue, expenses and profit. Okay. And the most important point is customer payments are irrelevant. Please look at the previous table. Customers have paid in year 1 15 lakhs, year 2 25 lakhs, year 3 30 lakhs. Okay. Yeah, but they are not relevant. They are not considered to be revenue. Okay, they are irrelevant information. I take you further, guys. The cost incurred under completed contract method, which are known as contract cost, are accumulated in a kind of intermediary permanent account known as contract in progress account. So this is how it looks like. So I have opened contract in progress T account. It is a kind of asset. It's a temporary asset. So that means, right, increases on the left hand side, decreases on the right hand side. I have also opened a T account, namely project expense T account. It is an expense, so increase in the left hand side, decrease in the right hand side. I have also opened a T account, namely cash or accrued expense. Okay, they are actually two different accounts, right? But I just clubbed it together. Sometimes you may also see this kind of practice. Okay, so that means if it is cash, it increases on the left hand side, opening balance on the left hand side, you can see that. If it is accrued expenses, it increases in the right hand side, so opening balance in the right hand side. And the last T account I have opened, guys, is project revenue T account. It increases on the right hand side, it decreases on the left hand side, right? So that means there are 3 years now. So that means it's a completed contract. So in year 1, right, the company is actually incurring a cost of 10 lakhs. So what happens is this: when you are increasing the cost of 10 lakhs, since you have not recognized revenue, you can't recognize expense, because that will lead to violation of matching concept. So what you are going to do is, you are going to increase your temporary asset, namely contract in progress, by the amount of the expense. So that means in year number 1, it is going to increase by 10 lakhs. If you close CIP, increase arrow side, put the total first 10 lakhs, make it equal on the other side 10 lakhs. So the difference is your closing balance for year number 1, which become opening balance for year number 2, 10 lakhs. Year number 2, the expense incurred is 20 lakhs. Add that, total is 30 lakhs. Make it equal on the other side at the end of year 2, 30 lakhs. That becomes the closing balance of 30 lakhs, because it's a permanent T account. Year number 3, that becomes the opening balance, 30 lakhs. Plus additional expenses incurred in year 3 is 20 lakhs. So the total expense is 50 lakhs. Make it equal on the other side, 50 lakhs at the end of year 3. And the amount of closing balance is actually 50 lakhs. Since you don't have one more year, since you are closing the contract at the end of year 3, you don't write closing balance. Rather you write transfer to project expenses. So if you look at project expenses T account, there are no entries in year 1 and year 2. I have written 0 because contract is not yet completed. But in year 3, the contract is getting over. So that means the expense is increasing in the left hand side. So that means I am increasing project expense 50 lakhs. Where from this amount is coming? It is coming from contract in progress account. So that means you can see here, contract in progress account, the amount is written in the right hand side, it gets transferred to the left hand side of project expenses account. If you close project expenses account, since it's a temporary account, at the end of year 3, this number will get transferred to income statement. Okay. Now let's look at the cash or accrued expenses. Had you paid cash on a yearly basis for all the expenses, you will decrease cash, right, for CIP account, the name of the other account. Year number 1, you will decrease cash by 10 lakhs. Year number 2, you will decrease cash by 20 lakhs. Year number 3, you will decrease cash by 30 lakhs. If it is accrued expenses account, you will increase accrued expenses in year number 1 by 10 lakhs, or year number 2 20 lakhs, year number 3 30 lakhs. Okay, please mind, this is either or. Have you paid cash? Decrease cash. Have you not paid cash? Increase your accrued expenses, right? I hope you guys are getting this, right? Yeah. So now let's look at project revenue account. Mind, we are following completed contract method. So that means year 1 and year 2 revenue recognized is 0. Year 3 revenue recognized is total agreed price of 70 lakhs. I have increased in the right hand side, put the total, make it equal. So that means the amount is transferred to income statement because it's a temporary T account. Otherwise we would have written closing balance, right? Yeah. So now let's go for the last T account, that is your income summary T account. Income summary T account is not income statement. So that means now revenue, right, transferred from project revenue, right, 70 lakhs, expenses 50 lakhs. So that means the difference of PBT, that is 20 lakhs. This is what you are, right, completed contract method. I repeat, if it is completed contract method, revenue, expenses and profit are recognized upon completion of the contract. If it is completed contract method, whatever cost are incurred, they have to be temporarily parked in a account, namely contract in progress. At the end of the completion of the contract, you will transfer the amount of expense to project expense, you will recognize project revenue, and then you will put that amount in your income summary, and then you will close the account, right? So this is what completed contract method. The next method is percentage of completion method. This is one of the most widely used method, as I told you already. Okay, so now we have to find out how much is the percentage of the work we have agreed, right, that got over at the end of every period. So there are two ways in which you can do. There are many more ways, but I can right now give you two, right, most widely used ways. One is on the basis of cost incurred, cost basis. Other one is on the basis of work completed. If it is on the basis of cost completed or cost incurred, it is going to be actual cost in that period divided by total estimated cost for the entire project multiplied by 100. If it is going to be on the basis of work completion, then it is going to be actual work divided by total estimated work for the entire project multiplied by 100. Okay, so the most important point is revenue, expenses and income. Income is nothing but profit, pre-tax profit, are recognized on period by period basis. In order to find out how much is the work completed, we are going to either use cost basis or we are going to use work completion basis, right? So let me just take you, okay, to the table under percentage of completion method. So let's first find out what is the percentage of completion for this company. Okay, let's take year number 1, 2, 3. Actual cost incurred 10, 20, 20. We are not using work completion basis in order to find out percentage of completion. Rather, we are using cost basis. So total cost is 50 lakhs for all, entire project. So that means year number 1, what is the percentage of completion? 10 upon 50 lakhs multiplied by 100, 20%. Year number 2, 20 upon 50 lakhs multiplied by 100, 40%. Year number 3, again 20 upon 50 lakhs multiplied by 100, again 40%, right? Yeah. So now let's go about computing how much is the revenue, expenses and pre-tax profit we are going to recognize on a periodic basis. So year number 1, 2, 3, you can see that. Okay, year number 1, percentage of completion is 20. Total agreed price is 70 lakhs. So revenue is 20% of 70 lakhs, so that is 14 lakhs. Year number 2, total completion or percentage of completion is 40. Year number 3 also 40. So that means 40% of total agreed price 70 lakhs, that gives you 28 lakhs. Year number 3 again 28 lakhs. How do you get that? 40% of 70 lakhs, 28 lakhs. Put the total of all these three, 28 plus 28 plus 14 gives you 70 lakhs. Now go for expenses. Expenses are actual expenses. So 10 lakhs, 20 lakhs and 20 lakhs. So 10 lakhs, 20 lakhs, 20 lakhs. So what is your pre-tax profit? 14 minus 10 for year number 1, 4 lakhs. 28 minus 20 for year number 2, 8 lakhs. 28 minus 20 for year number 3, 8 lakhs. Put the total of all the profits. How much it is? 4 plus 8 plus 8, 20 lakhs. Total expenses 50 lakhs. So in essence, the total is going to be one and the same. Only difference is under completed contract method, we recognize revenue, expenses and profit only at the end of the completion of the contract, whereas under percentage of completion method, we recognize revenue, expenses and pre-tax profit at the end of every reporting period. Okay, in order to know that, we need to know how to get the percentage of completion. For that, we are going either by cost basis or work completed basis, right? So that's it. So that is about the right percentage of completion method. let me take you through the last method of revenue recognition, which is commonly used, which is known as installment method, otherwise known as collection method. Nowadays, we are living in the world of EMI. So that means most of the companies which are dealing with durables or automobiles or even your financial loans, right? So they are given, right, at one time, whereas the seller or the service provider recognize revenue over a period of time, because the customer is going to make the payment, okay, over a period of time. So the most important point is customer payment is uncertain. He or she may pay or he or she may not pay. So that is where you talk about collection method, otherwise known as installment method. Let me take an example to explain this, okay? So let's take a company, namely Roli Devangshi Lohita Limited, RDLL. It sells washing machine. I am just taking one single unit. It sells a washing machine to a customer for INR 30,000. The cost price is INR 22,000 for the company, and it gives 2 installment to the customer. That means the customer is going to pay the total agreed price of 30,000 in 2 installment, equal installment. That means he is going to pay 15,000 INR in first installment, and he is going to pay the remaining 15,000 INR in the second installment. So the total cost is 22,000. Okay. So now, if it is going to be recognized under sales method, that means the company is selling the product, the customer is making the payment immediately, or the customer is certain that he is going to make a payment, for example, within a month. Okay. So that's a credit sales. If that is the case, you can follow sales or delivery method, because customer payment is certain. I repeat, customer payment is certain. So revenue is 30, cost of goods sold is 22,000, pre-tax profit is INR 8,000 if you are following sales or delivery method. Suppose if you are going to follow installment method, there are 2 types of installment method. The first one is known as pure installment method. The second one is known as cost recovery method. Now let's look at the first one, pure installment method. Okay, under pure installment method, okay, how revenue, expenses and pre-tax profit are going to be recognized is the question. So there are 2 years, year 1, year 2. So as I told you, the customer is going to make the payment in 2 installments. So that means collection is equal to revenue under installment method. So that means after 1 year, the company is going to get 15,000. How do you get that? 30,000 by 2. Second year again 15,000. So total revenue is 30,000. Expenses total is 22,000. So you are going to recognize expense in proportion to revenue. That means proportion of revenue is 15,000 by 30,000. So that is 50% of total expenses of 22,000. So that means recognize expense for year 1, that is 11,000. Similarly for year 2, 11,000. How do you get that? I repeat again, 22,000 total cost into proportion of current year revenue to total revenue, 15,000 by 30,000. That is 50%, guys, right? So 11,000 is a cost for year 1, 11,000 is a cost for year 2. So that means what is the profit for year 1? 15,000 minus 11,000, 4,000. What is the profit for year 2? 15,000 minus 11,000, 4,000 again, right? So what is the total profit? 8,000. What is the total cost? 22,000. What is the total revenue? 30,000, right? So the most important point here is, guys, under pure installment method, revenue and expenses are recognized in proportion, okay, of the revenue, right? Correct now? Yeah. I move ahead. I take you to the last method, which is known as cost recovery method. Look at the name, you will understand the meaning of this method. Okay, profit is recognized only after recovery of, right, total cost. So if you are going to follow cost recovery method, let's make a table. Year 1 to revenue, there is no change in it, because he is going to make 2 equal installment of 15,000 at the end of year 1, 15,000 at the end of year 2. So total is 30,000. Now when it comes to expense, if it is pure installment method, it is in the proportion of current year revenue to total revenue. That means 15,000 by 30,000 into, right, total cost of 22, that has given you 11,000 each. If it is cost recovery method, okay, so the entire revenue is taken as expense. For example, total expense in this case is 22,000, whereas the revenue for period 1 is 15,000. So that means entire revenue is taken as an adjustment for expense, that is 15,000. and the remaining expense of 7,000 is adjusted in the second period. Okay, because out of 22, 15 we have already recovered. The rest to be recovered is 7,000. So if you just recover that, the pre-tax profit for year 1 is 0, revenue minus expense 15 minus 15 0. Second year it is going to be 15,000 minus 7,000, so 8,000. So total profit is 8,000. Okay, so this is what cost recovery method. So that means profit is recognized after recovering total cost, right? Yeah, correct? Yeah. So that's it, guys. So in this video we have answered basically 5 questions. Question number 1 is what are the revenue recognition methods that are widely used by companies. Second one is how do you recognize RR under sales or delivery method. Third one is on RR under production method. Fourth one is about RR under percentage of completion method. There we also discuss about completed contract method. And the last question is about RR under installment method. Okay, I hope you guys have gone through it and you are understanding this. So thank you for viewing this video. See you in the next video, guys. Take care. Bye.